94,000 Bitcoin, gone. Not lost, not stolen, sold. Deliberately offloaded into the market over the span of 30 days by the very same institutions that spent years telling you Bitcoin was the future of money. And here's what makes this moment genuinely unusual. Institutional selling at this scale has never happened before. Not in 2021, not at the previous top. This is a record. So before you celebrate the next green candle or panic at the next red one, you need to understand what is actually happening here, because most of the commentary you are seeing right now is missing the real story entirely. By the end of this video, you will know exactly which institutions sold, why the reasons they are giving publicly may not be the real reasons, what this level of selling has historically meant for Bitcoin price, and most importantly, what the smart money that is still buying is actually seeing that the sellers are not. If you're someone who wants real analysis, not headlines, not hype, not fear-mongering, this channel is where that work gets done. Every video goes deeper than what you'll find anywhere else. Subscribe and turn on notifications so you never miss an analysis. And if this gives you perspective the rest of the internet isn't offering, the like button helps more people find it. Now let's get into what is really happening. In the last 30 days, institutional wallets and known custodial addresses linked to major publicly traded companies, ETF-adjacent entities, and government-connected liquidation accounts offloaded a combined total approaching 94,000 Bitcoin. The concentration of this selling came in waves, not a steady drip, but deliberate tranches that coincided with specific price levels, suggesting coordinated execution strategies rather than panic. The market absorbed most of it. Price wobbled but did not collapse. That single fact, that the market digested 94,000 Bitcoin in 30 days without falling apart, is something almost no one is talking about properly. On the surface, this looks like institutional capitulation. It looks like the so-called smart money is quietly exiting while retail investors are still getting excited about price charts. That's the headline narrative, and it's not entirely wrong. But when you look at who sold, when they sold, and what the on-chain data shows about where those coins went next, that is where the story becomes something entirely different. Think about what 94,000 Bitcoin actually represents. At current prices, that is somewhere in the range of $6 to $7 billion in notional selling pressure. For context, the average daily Bitcoin volume on major exchanges runs between $20 and $30 billion. So this selling, spread across 30 days, represented a meaningful but not overwhelming fraction of daily liquidity. The market was not crushed. It bent, and it held. And that tells you something important about the demand structure sitting underneath this market right now. Now here is where the data starts to tell a very different story. But before we get there, we need to understand the psychology driving the sellers, because without that context, the numbers don't fully make sense. The institutions that sold in this window largely fall into three categories. The first is government-linked entities liquidating seized Bitcoin. This includes tranches from enforcement actions that have been publicly reported. These sellers are not making market calls. They are operating under legal mandates and fiscal timelines. Their selling is algorithmic in the sense that it is policy-driven, not conviction-driven. The second category is early institutional entrants, companies that bought Bitcoin aggressively between 2020 and 2022, who are now taking profits or rebalancing portfolios under pressure from boards and shareholders who prioritize liquidity. The third and most interesting category is ETF-related rebalancing and arbitrage activity that creates selling pressure at the custodial level, even when end investor demand remains strong. Each of these three types of selling carries a completely different implication for where Bitcoin goes next, and conflating them into a single narrative of institutions are dumping fundamentally misreads what is actually happening. Stay with me because this next part changes everything. The crowd right now is reading this data through one of two lenses. Either they are terrified, interpreting record institutional selling as a signal that the people with the best information are heading for the exits, or they are dismissive, waving it away as normal profit-taking in a bull market. Both reactions are emotionally understandable, and both reactions are analytically lazy. The actual behavioral pattern that matters here is what is happening at the wallet level below the institutional surface. While 94,000 Bitcoin was leaving known institutional addresses, the on-chain data shows something remarkable happening simultaneously. Exchange reserves have continued their long-term decline. Wallets holding between 1 and 10 Bitcoin, the demographic that tends to represent upper-middle-class retail and small professional investors, have been accumulating. And perhaps most significantly, the cohort of wallets that have held Bitcoin for more than a year without moving it, what analysts call long-term holders, has not meaningfully decreased. The coins being sold by institutions are not flowing back into the pool of liquid, exchange-resident Bitcoin sitting available for sale. They are disappearing into cold storage. The crowd is looking at the institutional selling figure, Smart money is looking at where the coins land after the sale, and those are two completely different conversations. There is one number in this data set that almost no one is talking about. We will get to that in a moment. But first, let's put this selling event into its proper historical context, because this has happened before, in a different form, and what followed surprised almost everyone except the people watching the right signals. The most structurally similar historical event to what we are seeing right now is not the 2021 institutional wave, and it is not the post-peak distribution of late 2021. The closest parallel is actually what happened in mid-2019, when a cluster of early institutional and high net worth holders, people who had purchased in 2017 and ridden out the bear market, began systematic liquidation just as a new wave of interest was beginning to build. In that episode, selling pressure from the legacy cohort was absorbed entirely by a new cohort of buyers who had not existed in the previous cycle. Bitcoin went from around $4,000 in early 2019 to $13,000 by the summer, a move of more than 200%, right through the period of heaviest selling by the previous generation of holders. The second historical parallel worth examining is the period immediately following the 2020 halving, when miners, who had been the structural sellers in every previous cycle, found their selling capacity cut in half by the supply reduction. What appeared to be a bearish signal at the on-chain level, with miner wallets showing distribution, was actually a one-time clearing of inventory before a period of dramatically reduced new supply hitting the market. The pattern today shows similar dynamics. Government liquidations, like miner distributions, are one-time events with a defined ceiling. Once the seized Bitcoin is sold, that specific source of supply is gone. The history of Bitcoin is full of moments where record selling by one cohort coincided exactly with the beginning of a major price appreciation cycle. Not because selling causes prices to rise, but because the cohort capable of executing record selling is, by definition, the cohort that has been holding the longest. And when they exit, the coins transfer to buyers with a much longer time horizon and a much higher price target. This is the generational handoff that has defined every major Bitcoin bull run in history. Now let's talk about what the on-chain data is actually showing beneath this institutional selling event, because this is where the analysis gets genuinely important. The metric I want to focus on first is exchange net flow, the difference between Bitcoin flowing onto exchanges ready for sale versus Bitcoin flowing off exchanges into private custody. Over the past 30 days, despite 94,000 Bitcoin in institutional selling, exchange net flow has remained negative. Coins are leaving exchanges faster than they are arriving. This is the structural opposite of what you would expect if the selling was being driven by broad market fear. When markets are in genuine distress, coins flow onto exchanges as holders prepare to exit. When coins are flowing off exchanges at the same time institutional players are selling, it means the institutional selling is being absorbed by buyers who are immediately withdrawing their purchases to cold storage, treating every dip caused by the institutional selling as a buying opportunity. The second metric worth examining is the MVRV ratio, market value to realized value. This measures the relationship between Bitcoin's current market price and the aggregate price at which all existing coins last changed hands. At levels above 3.5, MVRV has historically marked the zone where long-term holders begin serious distribution. At levels below 1, it has historically marked generational buying opportunities. Currently, MVRV sits in the mid-range, not overheated, not at a floor. This is the zone where cycles tend to have the most violent and least predictable short-term moves, but where the asymmetric risk-reward for medium-term holders has historically been quite favorable. The third data point, and this is the number I mentioned earlier that almost no one is discussing, is the rate at which corporate treasury buyers have been increasing their Bitcoin holdings even as the institutional selling dominates headlines. The aggregate corporate treasury Bitcoin position has actually increased over the 30-day window in question, which means that while one class of institutional player was selling, a completely separate class of institutional player was buying at a faster rate than the selling. The net institutional position, properly measured, did not decrease. It increased. That changes the way you should think about the entire situation. The macroeconomic backdrop for this selling episode is worth examining carefully, because Bitcoin does not exist in isolation from the broader financial system. The current environment features three converging dynamics that create both the conditions for institutional selling and the conditions for what comes next. The first is the interest rate environment. After one of the most aggressive rate hiking cycles in Federal Reserve history, the market is navigating a period where the direction of rates is contested. When rates are high, institutions that hold Bitcoin on balance sheets face greater opportunity cost. The yield available from holding cash or short-term treasuries is real. This creates genuine incentive to reduce Bitcoin exposure and redeploy into yield-bearing instruments. This is not Bitcoin failure. This is capital allocation logic under specific monetary conditions. And it is precisely the dynamic that reverses when rates begin to fall, releasing the capital pressure that has been suppressing institutional appetite. The second macro dynamic is dollar strength. The relationship between Bitcoin and the dollar index is not perfectly inverse, but it is directionally significant. Periods of pronounced dollar strength have historically coincided with Bitcoin underperformance relative to its underlying adoption curve. The current dollar strength is real, but it is occurring against a backdrop of widening fiscal deficits and expanding debt obligations that structurally pressure the long-term value of the dollar, the precise environment for which Bitcoin was designed. The third dynamic is the post-halving supply compression that is now approximately 1 year underway. Every previous Bitcoin halving has been followed by a supply shock that, with a lag of 12 to 18 months, has contributed to significant price appreciation. The mechanism is simple. 60% less new Bitcoin hitting the market from miners against flat or growing demand creates tightening. The 94,000 Bitcoin sold by institutions over 30 days is a one-time event. The supply reduction from the halving is permanent and compounding. Now let's look honestly at both sides of what this data could mean. The bull case is compelling, and it is grounded in structural realities. Institutional selling of this magnitude historically has marked the clearing of a legacy cohort, one that bought early and is now exiting at profit, and has preceded the entry of the next, larger cohort. The combination of negative exchange net flows, growing corporate treasury accumulation, post-halving supply compression, and a potential Federal Reserve pivot toward easier monetary conditions creates a backdrop that has, in prior cycles, preceded Bitcoin's most aggressive appreciation phases. If on-chain accumulation by new buyers continues to absorb institutional selling without driving exchange reserves higher, the supply shock thesis remains intact, and the path of least resistance for price is upward on a medium-term horizon. The bear case deserves equal weight and intellectual honesty. Record institutional selling is not a trivial signal. If the selling represents a genuine shift in conviction among large holders, rather than a one-time clearing event, then the demand absorption we are seeing could be temporary rather than structural. There are scenarios in which the corporate treasury buyers who appear to be offsetting institutional selling are themselves leveraged or cyclically sensitive, meaning their buying could slow or reverse under macro stress. There are also scenarios in which government-linked selling is not a one-time event, but the beginning of a sustained policy of liquidating seized Bitcoin reserves, a supply overhead that has historically been difficult to price. The bear case is a real case, and anyone who dismisses it is not taking this market seriously. In the next 30 to 60 days, there are specific developments that will clarify which of these scenarios is actually unfolding. The first is the trajectory of exchange reserves. If the selling continues but exchange reserves remain flat or declining, the bull case strengthens materially. If exchange reserves begin rising, meaning coins sold by institutions are landing on exchanges rather than in cold storage, that is the signal that demand is weakening in a meaningful way. The second development to watch is corporate treasury earnings reporting. The companies that have been accumulating Bitcoin will face balance sheet scrutiny over the next quarter, and their guidance on Bitcoin holdings will tell you whether the corporate accumulation trend is durable or opportunistic. The third signal is the Federal Reserve's language at the next policy meeting. Not the decision itself, but the explicit framing around future rate direction. A clear pivot toward cuts is the most powerful potential accelerant for institutional Bitcoin re-entry. Watch these three signals in sequence. The picture they paint together will be far more valuable than any single data point viewed in isolation. Here's the bigger thought to take away from all of this. Every major turning point in Bitcoin's history has been announced in advance by data that most market participants were not reading correctly. The 94,000 Bitcoin sold in 30 days is either the end of something or the beginning of something. The on-chain data, the historical pattern, the macro context, and the behavior of buyers absorbing that selling all point toward the same conclusion, that the category of seller matters more than the quantity of selling. And when you map the sellers onto the historical cohort analysis, the sellers look like the past, and the buyers look like the future. Bitcoin has survived Mt. Gox. It has survived China bans, FTX collapses, SEC enforcement waves, and every other moment where the smart money was supposed to be heading for the exits. What it has never survived is the permanent disappearance of the demand that has historically arrived after every major clearing event. And right now, that demand appears to be showing up exactly where the data suggests it should. The real question is not whether institutions are selling. They are. The real question is this. Do you think the buyers absorbing 94,000 Bitcoin in 30 days without cracking the market are early, or do you think they are already too late? I want to know what you actually think in the comments below.